Hey everyone, welcome back to Corporate Decoder. Today, GNSS just filed an 8K, and I am seeing a significant debt increase. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a new loan, and the terms are pretty interesting, especially the interest rate and fees involved. Alright, let's dive into what Genasys Inc, ticker GNSS, has reported. This is a current report, meaning something important happened recently. Genasys is a company focused on technology, specifically in scientific and technical instruments. They're a smaller company with a market cap around $86 million, and their stock has been trading between $1.4 and $2.7 over the last year. We've seen some positive news lately about their Evertel product being used by police and a new partnership for evacuation information. They also recently beat earnings estimates in May. The main event here is about a new loan. On the 9th of June 2026, Genasys entered into a loan agreement with Maran Partners Fund. LP, this is a pretty big deal for a company their size because they're taking on over $4.3 million in debt. The closing for this loan also happened on the same day. What is this money for? The company says it is for working capital and general corporate needs. This usually means day-to-day operations, paying bills, and potentially funding ongoing projects, but it is not tied to a specific new product launch or a big capital expenditure. Now let's talk about the terms of this loan. It is an unsecured term loan, meaning Genasys did not have to put up specific assets as collateral. They have to make monthly interest payments, but the entire amount, the principal, interest, and any fees, is due on the 14th of September 2026. That is a very short repayment period. Only about 3 months from when the loan was taken out. The interest rate on this loan is a hefty 18% per year. That is quite high, especially for an unsecured loan. And if they default on the loan, meaning they miss a payment or violate a condition, the interest rate jumps up by an additional 5%, making it 23% per year. That's a serious penalty. On top of the interest, Genasys had to pay an origination fee of $301,000. This fee was taken directly out of the loan amount, so they didn't actually receive the full $4.3 million in cash. They received $4.3 million minus this fee. There is also an exit fee that is like a prepayment penalty. If they pay the loan back before the 13th of July, it is $64,500. If they pay it back after that date, but before the September deadline, it is a much higher $150,500. This structure strongly encourages them to pay the loan back as quickly as possible, ideally before mid-July. Like most loan agreements, this one has a lot of other conditions. It includes things like the company promising that certain information is true about them, and they have to follow certain rules. These are called covenants. The covenants restrict Genasys from doing certain things without the lender's approval. This includes things like taking on more debt, selling off major assets, or paying out money to shareholders. There are also standard clauses about what happens if they fail to meet their obligations. Interestingly, the loan agreement also has conditions for mandatory repayment. This means the lender could force Genasys to pay back the loan early if certain things happen. These trigger events include a change of control of the company, selling assets outside of their normal business operations, or if they issue a lot of new stock. On the flip side, Genasys can pay back the loan early without penalty, but they need to give the lender 30 days notice and do it in $250,000 increments. This confirms the strong incentive to pay it off fast. This section simply confirms that the loan described in item 1.01 creates a direct financial obligation for Genasys. It is essentially cross-referencing the previous information. And finally, the exhibit list just points to the full loan agreement itself as Exhibit 10.1. This is where all the fine print is located. The report is signed by Cassandra L. Hernandez Montión, the Chief Financial Officer of Genasys Inc., dated the 12th of June 2026. This indicates the filing was made a few days after the loan agreement was signed. So what does this all mean for Genasys? This loan definitely looks like a short-term fix. The high interest rate of 18%, the significant origination fee of $301,000, and the very short repayment window ending in September suggests that Genasys might be facing immediate cash flow challenges. The high exit fee for paying it back later also pushes them towards a quick repayment. Think about it this way. If you took out $4.3 million at 18% interest and had to pay it back in 3 months, you'd be paying a substantial amount in interest alone, plus that origination fee eats into the capital they actually receive. This strategy is often used when companies need funds urgently and have limited options, or when they expect to secure financing from other sources very soon. perhaps from an equity raise or a more conventional loan. Given the recent news about their technology being adopted and beating earnings, it is a bit contradictory to see them taking on such expensive short-term debt. It might indicate that while their technology is gaining traction, their operational cash flow is still tight. One historical comparison for companies taking on expensive short-term debt like this is often related to companies struggling to manage their immediate liquidity. For example, companies like Tupperware or Rite Aid in their more challenging periods have had to resort to similar high-interest financing. While Genasys is not in that dire a situation based on recent news, the financial instrument itself signals a need for quick cash that carries a significant cost. A $1,000 investment in a company taking on such a loan might see its value impacted, not just by the company's performance, but also by the drag of these high financing costs if they aren't resolved quickly. The risk here is that if Genasys cannot repay this loan by September or refinance it on better terms, the default interest rate of 23% would become a huge burden. Also, the mandatory prepayment clauses mean that if something positive happens, like a big asset sale or a new equity round, they might be forced to pay this loan off anyway, potentially incurring that higher exit fee. What is actually interesting is how they plan to manage this. Will they be able to generate enough working capital from their operations or secure more favorable financing before the September deadline? The quick repayment incentives suggest they might have a plan, but the high cost of this loan is a clear drain on their resources. And the research tools that I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.